Chart Watchers, and welcome to this Thursday, April 26th Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. You can see today we are having a much better day than we've seen the past 6-7 trading days. Dow Jones Industrial Average currently up 165 points, the S&P up 19, the NASDAQ up 91. The Russell 2000 really lagging today, only up 2.5 points. Kind of surprising. The dollar was up earlier, but I would expect to see that relative strength begin to come back in on the Russell 2000. 10-year Treasury yield after hitting the 302 area yesterday, closing above 3%. It is back down just slightly below at 2.996 at last check. Volatility index, wrote about this a little bit in my blog this morning, but you can see these two tails. We did close well off the intraday highs in volatility, and that sometimes can mark highs, as we saw back at the end of March, early April, and we are starting to turn back down in volatility. That's a good thing for the bulls. Internet stocks helping to lead technology on the sector leaderboard. Technology is one of the strongest areas of the market, and part of that reason is because of internet. Facebook came out with their earnings, absolutely blew away top and bottom line numbers. I think shocked a lot of folks. Now up against some overhead resistance, couple of gap resistance areas that Facebook is trying to negotiate now. Industrials on the other end of the spectrum, however, struggling, down almost 1% today. The transports are really getting hit hard. Railroads, while they were weak earlier, they are following an uptrend and actually look to be trying to hold on to rising moving averages. Truckers, on the other hand, though, really disappointing action today. We are seeing breakdowns in the index and watching some individual truckers pretty closely. Finally, the top performing stock in the Dow so far today, Visa. Visa making a huge move after earnings, breaking out above the consolidation that it has been in for the past several months. And we'll want to take a look at Visa a little bit later in the show. But for now, let me bring in my co-host, Erin. How are you doing this morning, Erin?
I'm doing great this morning, getting ready for my workshop later.
Awesome. I tell you what, I think our sprinter has ended here in the Southeast. It is another day going up into the 70s. I looked at the 10-day forecast, and I don't see any freezing temperatures.
Nice.
Looks like it's going to be in the 70s to around 80 for the next 10 days.
Sweet.
I think it's over. I think it's done.
All right. Well, you can join me. I think our high today is 79. I haven't checked the rest of the week. It's probably around the same. It's kind of boring around here.
That's probably pretty chilly for you.
Yeah. So I'm glad that I'm here. I'm awake, and I have great weather to look forward to. So.
Yeah, I'll tell you what, in the market, I know traders are looking forward to a lot of earnings reports. We got a ton coming up after the close today. This is one of the bigger earnings days. It seems like Wednesdays and Thursdays, I haven't gone back and looked, but it seems like Wednesdays and Thursdays is when we see the majority of the reports come out. And as you get toward the end of the first month after a quarter ends, that final Thursday seems to be when we get a lot of big companies reporting, and that will be the case again later tonight when we get Microsoft and Intel and Starbucks and some others reporting. So we've got a lot to go over, plenty of earnings reports. I know you got your workshop, so let's get into the announcements and the agenda and get everything going.
Absolutely. So coming up this week, we have everything stock charts coming up Friday, tomorrow, and we'll get some good helpful hints and tools there. We have Tom doing on, I guess that is Monday, right? Seasonality report. And he'll give us the scoop about what seasonality is going into May. I will be going over the monthly charts from April on Tuesday, because they will have gone final. And then we have Tom McClellan as our guest on Wednesday. I'm so very excited. He had a lot to say to us when he came in, I think it was in January, about a possible decline in the April-May timeframe. So I think it'll be really interesting to talk to him. And finally, we have Bruce Frazier after that. So it's going to be a packed week next week. And again, we have everything stock charts coming up tomorrow. But today we have coming up Moving Averages Workshop. I'll be going over moving averages, and I'll get into that later, but it should give you a really good review and probably some things you may not have known already. 10 and 10 to 1, our first symbol is going to be GOOS, Canada Goose Holdings. So if you want to take a peek at that chart before we get there. And then finally, Tom's going to go over some correlations at the end of the show. And with that, I'm going to pass it back to you, Tom, for our technical headlines.
Sounds good. Well, here is your 10-year Treasury yield. You can see the month of April, we've seen a lot of movement to the upside in the Treasury yield, meaning money has been rotating away from bonds. And usually that's a good thing for the stock market, although April, we got off to a pretty good start. Let's pull up the S&P 500 so you can just kind of see what was happening. Early in the month, we did pull up, move higher, probably from the low of, 2555 or so on the S&P 500. We did rise about 150, 160 points. So pretty nice move in the first half of April, but we have seen some weakness the past week or so, even though the yields have moved up above 3%. Some are calling for the higher interest rates, to mark maybe a top in equities. I do not think that is the case at all. I still believe interest rates are near historic lows, much closer to historic lows than the highs that we saw many, many years ago back in the 80s, I guess late 1970s, early 1980s. But anyhow, I think as long as interest rates are moving up because of economic growth, I think we're fine. Now, I think if we start raising rates because we're battling inflation, that could be a different story. But I'm still in the bullish camp at this point. Again, you can see the S&P 500 actually putting in a nice little reversal yesterday. We took out the intraday low from Tuesday on the low yesterday and then reversed off of that. And now we're higher, trying to get back through the 20-day moving average. That will be the next key for the S&P 500. But getting back to that 10-year Treasury yield, you can see we did make the big move, made the breakout above 295. I'm looking for a little consolidation now, maybe down to that rising 20-day moving average and the highs that we saw back in 2014, which is around 305. So I wouldn't be surprised if we kind of hover now here in this 15-point basis point range for a little while. Let's take a look at the NASDAQ. This is the index that I tend to watch. I do a lot more trading on the NASDAQ than I do on the other indices. I do see, similar to the S&P 500, we're moving up, trying to get through the 20-day moving average. I did put in my chart, or in my blog earlier today, a chart of the hourly NASDAQ. And first thing I wanted to do was see whether we could get through that 20-hour EMA. If you notice, when we're trending higher, we tend to come back, pull back to the 20 and then rise. And then when we fall below, we tend to struggle when we move back higher. So today, so far, we gapped above it and we are holding it. There is some area around 7,100. This is where we're kind of jockeying back and forth, sitting at 7,097 right now. I'm going to pull up just a 2-month chart of this, stick with the 60-minute chart, and then I'm going to annotate and show you the 7,100 level. We've been right on the 7,100 area multiple times over the past couple of months. You can see a major low established back in early March at 7,100 before the bounce. We had a little bit of back and forth here, but look at the double top that came in at 7,100, all these failures at 7,100. Then we got through, and on the pullback, you can see we held 7,100, fell below it, and now here we are trying to battle again. So 7,100 has just been one of those magnets for the NASDAQ where we keep gravitating back and forth to that area. At this point, unable to break through, but so far holding that rising 20-day moving average, that now rising 20-day moving average. So we're squeezing in a pretty tight range, I would say within about a 0.5% range on the NASDAQ. We've got that rising 20-day moving average, 7,065, and then we've got that overhead resistance right at about 7,100. And again, if we pull out of this, take a look at that daily chart again, I think you will see, well, let's take a look. Let's get to the daily chart. And there is that falling 20-day moving average, which is at 71.22. So maybe what we say is 70.65 to about 71.25. So let's give it a 60-point range, but still that's less than 1%. Let's see which way we go here in the near term. I do want to say that as we move toward the end of April, and of course tomorrow's the 27th, Monday's the 30th, we do have a historical tendency to move higher into the end of April and the first week of May. So if we can get back through some of these levels, history at least would support a continuing move to the upside. Let's take a look at, it was in my blog under the sector industry watch today. I was looking at the home builders and also at the home improvement stocks, and comparing that to the 10-year treasury yield, because a lot of folks are out there. I've seen so many articles recently talking about how the 10-year treasury yield is going to slow everything down because we're rising so much. We are still very close to historic lows on the 10-year treasury yield. I don't believe that a 10-year treasury yield of 3% is going to provide huge headwinds for the stock market. I just don't think it, or for the housing market, for that matter. If you take a look at the huge run that was made in the fourth quarter of 2017, maybe even a little bit before the fourth quarter, into early 2018, look at home construction. I mean, it was the best performing industry group, along with, I think, maybe renewable energy. Home improvements also had a huge run into the end of the year. The 10-year treasury yield was rising throughout this period. I don't remember anybody coming out and talking about how the rising treasury yields then were resulting in awful performance by home construction and home improvement stocks. But a lot of times, if it fits the story, then you go with it. And over the past few months, these groups have pulled back considerably. I think it was because they were simply so overbought more than anything else. If you look down here, the home construction group this is a longer term weekly chart that I'm looking at. So this is a weekly RSI. To see the weekly RSI get up to 90 is almost unheard of. And you look at the chart, and there was just no pause. So I think, you have to have some patience. You got to give this group, both of these groups, a little bit of time to consolidate here before perhaps resuming all of that bullishness that we saw before. But now that the 10-year treasury yield's rising and we're seeing a pullback, everyone wants to blame interest rates. I just think the groups needed a break, and this is the excuse du jour. Let's take a look. Well, I do want to mention, too, I mentioned at the top of the show, but major earnings reports coming out after the close tonight. We have Intel, Microsoft, Starbucks, Baidu, KLA-10 Core in that key semiconductor space, the travel company Expedia. A number of companies that can really move the NASDAQ are going to be reporting after the close today. So not only are we looking at what happens today in the NASDAQ, but there's a lot of news coming up at the end of the day that we're going to have to watch to see maybe how tomorrow may start. But if we get some nice earnings reports and we finish strong today, again, keep in mind that seasonality tends to be very strong as we end April and begin May. Now let's take a look at some earnings, companies that reported earnings last night and this morning. Visa reported last night, and you can see a huge reaction. This is the top performing Dow stock, up 4.48%, trying to make a breakout above the late January high. And when you look at the S&P 500, you can see that we are nowhere near making a breakout. So what does that tell you? It tells you, if you go back and you pull up the Visa chart in that relative chart form that I like to use, it's going to show that Visa has been a great relative performer to the S&P 500. This is the kind of stock you're going to make money in, and this is the type of stock that you're going to outperform the benchmark index. It's been a great performer. The industry group itself is making a move today because of Visa, but if we could clear the September high in the group, or actually the relative high, this is the relative high of Visa versus its peers. Here is its peers, the absolute chart. I think it's a very bullish looking chart, by the way. Equal highs, higher lows. I see a nice little triangle forming, and I would not be surprised to see a breakout and Visa leading the way. So this breakout, if we do get it at the close today, would be very meaningful for Visa. And they did beat top and bottom line. I have so many earnings reports here, and I want to get through a bunch of them, so I'm not going to go through the exact numbers. But Las Vegas Sands beat top and bottom lines, not really showing us anything here. Continuing to consolidate. Again, if we look at the relative chart, what you're going to see is a group, the gambling index, that is consolidating after a huge move up back in January. I still like the group, even though it's been down here recently. Las Vegas Sands, relative to the group, is making a move back toward its recent high. So if you're in a good group and you're nearing or you're making a relative breakout amongst your peers, chances are you're going to be doing pretty well versus the S&P 500, and that is exactly what we've been seeing with Las Vegas Sands. So still bullish the stock, even though earnings are out and we're not getting a huge positive reaction. Of course, we can't possibly go on without talking about Facebook. Facebook, I am going to give you these numbers. They were amazing. 11.97 billion in revenues. Market was expecting 11.45 billion. Bottom line, a buck 69. Market looking for a buck 36. It's a major company just absolutely blowing away estimates. That is very impressive. We do still have some overhead areas I was mentioning in my blog. I really thought this 170, 172 and a half area was going to present some problems, but we opened above it, which I think is a good sign. 173.22 was the open. Now we've got some major gap resistance up above at about 177 to 177 and a half. I think we're going to get there with Facebook. And then the question is, can we close back above it? I think if we close above it with the volume picking back up, maybe all this was a little hiccup on that long-term chart. I'm really surprised. I thought there was a lot of distribution taking place. Did not expect this kind of report out of Facebook. But hey, that's why the earnings reports are such a shocker sometimes. You'd think based on looking at the chart that maybe a report's going to be one way or the other. In this case, Facebook, huge move to the upside. PayPal did beat top line, beat on bottom line, but just kind of going along in the middle here, not really doing anything. I still think it looks great. I think when you look at it from a longer term, weekly perspective, you got a great performing stock, but at the top, higher highs, lower PPO, you got a negative divergence. It's going to take a little time to unwind this. So even though we got great results, I think the consolidation continues here with PayPal. ALGN's been one of the best performers in the market. It's a smaller company, but you can see it's been going sideways. They came in with another great report, blew away top and bottom line estimates. Let's pull up that weekly chart on Align Technology, and you'll see the exact same thing I was just talking about with PayPal. Beautiful move up. As we move up, the PPO at each one of these highs continues rising until this one. We bounce off the 20-week, move back up. Look at this higher high, lower PPO, reversing candle. And here it's been 3 months now. We just still can't get going, even with another great report out of Align. They beat, by the way, by more than 5% on the top line, and they beat by almost 20% on the bottom line over expectation. So great company. Simply needs some more consolidation. I think Align is something to watch. Now, Chipotle, this was one that from a technical perspective, I think is very significant. Sideways consolidation. This comes after years, last few years of a downtrend. I'm going to pull up the longer term. Let's go back 3 years and 6 months. And you can see this has been trending down and down and down. But after going sideways here for the last 8-10 months, huge move up, and look at the volume coming in. I think this is very significant for Chipotle. They did just meet expectations on the top line, but they blew away the bottom line, 213 versus 154. And so you can see a huge move higher here. I don't like to chase. Again, this is one that I would try to wait, but the top of gap support, I don't know if we're going to come all the way down and fill this gap. I think the top of gap support on this stock could be in play on any pullback in the future. AMD, Advanced Micro Devices, beat top line, beat bottom line, and trying to resume its prior trend. This is another one that's been struggling for a while if we go back and look at the weekly chart. But this sideways consolidation, this breakout at about $9, it's been holding, and now we're starting to turn back up again. I don't know if I'm quite ready to jump in on the AMD bandwagon. I think Intel's been a better performer, but nonetheless, it is having a great reaction today to its earnings. Did want to mention a couple of others real quick. Let's actually take a look at eBay. eBay, and actually, I don't think I got that ticker in there right. There we go. eBay is moving lower. They reported earnings. Now, I talked about this one, I think, yesterday or the day before, and I like to pulling back to the key gap support, the 20-day moving average, but we cannot ignore anytime a company reports earnings, and you can see eBay with its earnings down 6.3% today. Not a good move at all. And let's pull up one more. Let's go with Baxter, BAX, Baxter International. Big move up here. I think this breakout here at 69 is significant. I'll tell you why. We look at the relative chart, and what you're going to see with Baxter is a company that's been moving higher, consolidating for a bit. Medical supplies has actually been moving down for the last 3 months, but look at what Baxter's been doing relative to the group. It is breaking out to a new high versus its peers. So if the group itself, if medical supplies starts to move higher, and you can look at the relative breakout versus the S&P as well on Baxter, but medical supplies in April starting to regain strength. And so I think if Baxter can hold this breakout level at $69, I would look for some renewed or maybe continuing relative strength in Baxter. So I think it looks good. With that, I'm going to turn it over to Erin for her workshop on moving averages. Take it away, Erin.
All right. Well, before we start, we do have a poll running right now that I think would be interesting. I'll check it again after we're done with the workshop. But which moving averages do you primarily use? And interestingly, a lot of people do like you do, Tom, and they mix both on the same chart. I personally like to use exponential moving averages, and we can see some people use the SMAs, and there's a few who don't use moving averages. So there we go.
I am shocked at this.
Yeah, right?
I am. I thought I was the weird one. I really did.
I really did too. I'll tell you, Tom. I don't know. I think you're still one of the weird ones, but I think it's really important, though, especially if you're using two on the same chart, to really understand the differences between them. And that's what I want to get into as part of my workshop. So anyway, I'm going to go ahead and get started with that. All righty, start the play here. All right, I think that looks good. All right, so yes, I'm going to go over moving averages today in my workshop. I am Erin Swenlin, for those of you who do not know. So I'm going to start off with letting you know that most of this information, in fact, the majority of it, I got from Dr. Alexander Elder's book, The New Trading for a Living. I cannot recommend this book more. It is a great beginner book. He speaks in language that might be easier for those less experienced in technical analysis. So I highly recommend you go check that out. We do have it in the Stock Charts bookstore, and you can find the link to the Stock Charts store at the bottom of any of our web pages. And we do sell it cheaper than Amazon. I'm pretty sure we do that. Most of our books are cheaper than Amazon. So go take a look. And so let's get started here. I'll get back here. All right. So I'm going to go over the history of them. I'm going to, of course, give you the definition. There are three major types of moving averages, so we'll go through those. And then I'm going to give you some of the general trading rules that Dr. Elder recommends if you're using one moving average. And then we're going to look at dual moving averages. And in fact, I'm going to go over the DP trend models because they are completely based on using two moving averages and sometimes three. So we'll go take a look at dual moving averages as example using the DP trend models. So first of all, the history of moving averages in technical analysis. Actually, it was brought to the markets after World War II. Apparently, the anti-aircraft gunners used to use those moving averages to sight their guns on enemy airplanes. But it was taken by Richard Donchian and J.M. Hurst. I don't know if you're familiar with them. Apparently, neither of them were gunners. But both of these, let's see, Donchian was a Merrill Lynch employee, and Hertz was an engineer. And they both applied moving average crossovers to the stock market. And so that happened quite a while back. The most important thing you should remember about moving averages, there's two. Number one, as far as the definition, a moving average reflects the consensus of value of the data within its time window. So especially when we're talking about price in the stock market, we want the consensus of value of that data within its time window. It tells us what people are thinking about where the price is based on just the moving averages. Is it above or below that moving average? And that tells us some information. All right. The single most important message of a moving average comes from the direction of its slope. So it's not necessarily all about crossovers if you use two, and it's not necessarily about the location necessarily of price in relation to it, but the direction of the slope is what tells you the most information out of a moving average. So there are three types of moving averages. The first is the simple moving average, or just an SMA, or a lot of times I see it as just MA. And then, of course, there are the exponential moving averages, which I prefer. And then there are various weighted moving averages that you can use. So I'll go over a few of those just in general. So first of all, the simple moving average, it's just like you learned in school. You take all of the data, add it together, and then the number of those items is what you divide it by. So in the terms of price, we take the price from day 1, day 2, all the way up to however many days are in our moving average period. And then we just divide it by the number of days that we use. So pretty simple to understand. And that's really one of the advantages of using a simple moving average. They're really easy to calculate, and intuitively everybody understands what they're showing. But there are a few disadvantages to using the simple moving average. And one of them, the most important to understand, is the drop-off effect. And I'm going to just show you an example here. You've got a 10-day simple moving average. So when you're adding them all together and you divide just by the number, which would be 10, each data point is going to contribute 10% to the average. So if there's a large value that you have, maybe there's an outlier in price, say you got that gap up on earnings or whatever, and then it brings it back down, you are going to skew reality a little bit, because as that big price drops off on the end, your moving average is going to really move in a different direction. So it's not going to give you the actual reality of the trend, is what Dr. Elder says, and I have to agree with him there. But I think there is the advantage, again, because you can understand it and you know what's happening with it. And so that's why we do have a lot of traders who use them. And I know, we're looking at a 10-day simple moving average example here. But obviously, if you're looking at a 200-day moving average, now you're talking about each piece only, contributing a small amount to the average. So it's not as, you're not going to get the skew quite as much on the longer term, which is why I know, for example, Tom uses the simple moving average for his longer term averages. And that's just fine. So, but the shorter you make your simple moving average, the more it's going to bounce around and not necessarily give you the true direction of what's going on with the trend. So that's why we have the exponential moving average. And the calculation is a bit more complicated, but I'm going to try and simplify it here for you. So there's 3 steps. First, you calculate the simple moving average, and that's because you have to have a starting point. So you start by calculating that simple moving average, and then you go ahead and you calculate the weight multiplier, And an exponential moving average is actually a weighted moving average, and that's because it gives more weight to the most recent data, and that's just through the calculation. So you calculate the weight multiplier, and then you calculate the EMA. So how do you get to the weight multiplier? Well, it's simply 2 divided by your time period plus 1. So for example, a 9-day EMA, the weight multiplier would be 0.2. It's pretty easy little figuring out that. I used, of course, the 9-day to make it more clear. So that is our weight that we apply. And that's how you calculate the EMA. You take the close, you minus yesterday's EMA, and then you go by the weight multiplier. And then you go ahead and you add yesterday's EMA to that. So basically, you're weighting each close every single day. And so the more recent data is what's going to show up a little bit more strong in the exponential moving average. So that's really where your advantages are. The disadvantage, I didn't write those down, but obviously the disadvantage to an EMA is it is a little bit more difficult to understand. And so a lot of people don't use them just because intuitively it's hard for them to imagine it, I guess you might want to say. So it's better for trend following if you use the EMA. And that is because you don't get any of that drop-off effect. You get the greater weight on the most recent data. And for me, when I'm studying what's going on with price in the market, I really I care more about the trend that's going on at the front end of my average rather than all of those later values from the end of that series. So there you are. You get less, or you don't even have much of a drop-off effect. So I think that's really the primary advantage to using the EMA. There's also weighted moving averages, and these are, you're basically applying a weight wherever you want to. So for example, I know there's the geometric moving average. So that's where you're multiplying price on the weighting. And then you have volume weighted moving average. You multiply maybe by the volume each particular price in that series. So now you're getting the volume weighted moving average. The triangular moving average, it's sort of it is like a triangle because it puts the most weight in the middle rather than on the ends. So it's considered a triangular moving average. And I believe all of these you can go into chart school and see exactly how they're calculated. But for me, I think the volume weighted might be an interesting one. I've used that a few times, but I really prefer just using the EMA. So the question then is, okay, well, how do I determine how long I want the moving average to be when I'm studying, my price chart? And everybody uses all different kinds. Just for information, I know that Dr. Elder uses a 26-day EMA and a 13-day EMA. And what it is you have to realize what your time windows are. So are you really interested in the very short term? Are you a day trader? Are you a very short-term trader? Well, then you want to make your time window shorter, obviously. But you have to remember, and we discussed this when you are putting together, for example, your simple moving average, remember it's going to bounce around if it's a small time window. So if you have a 10-day moving average and each piece of data is contributing 10%, you're going to see a lot of whipsaw back and forth. So he actually recommends using nothing less than an 8-day EMA moving average. So I actually use a 5-day, but I understand the fact that I am going to get a lot of that whipsaw. So I'm prepared for that. But I do want it to be very short because I want it really sensitive to what's going on in the short term, because I use the 5-day EMA as part of the short-term trend model. The optimum length of your moving average, and again, I know he uses the 26 and 13-day EMAs, but what he says is really what you want is a moving average that is half the length of the dominant cycle that you're looking at. So if you're interested in the last month of trading, but you want to look at then a smaller moving average. So you're looking at a 20-day, and you want to take half of that if you were looking at the dominant cycle for that month. So that's how he recommends doing it. The majority of people use a 20-day EMA and 50 and a 200. I mean, that's pretty much the typical lengths that you're going to see. And then some, like myself, use a really short-term EMA to give me that really sensitive movement within those very short-term trends. One thing that I didn't talk about here when you're looking at an EMA is that the one nice thing I like about the EMA is that if price goes above that moving average, the EMA is going to turn up. And if it goes below that moving average, the EMA will turn down. I mean, that's just how the calculation works. So I think that makes it easier for you to determine, okay, are we really getting close to a crossover? Is that shorter term EMA moving toward or away from the longer term? That sort of thing. I'll show you a few examples. First, he has 3 general trading rules if you're trading with one moving average. So the first one is if you have a rising EMA, and again, that means your price went above it. What you want to do is plan on trading from the long side. So you think about it, your price went up through that EMA, and that turned it up. So now you have an EMA that's rising. What he says is try to wait till it comes back down toward that moving average before you go in. And I'll show you that example. And you want to set your stop below the latest minor low. And again, these are his Dr. Elder's rules and what he considers the best way to set a stop. And then once you raise that stop, once prices rise to a point where you can set the stop to a break-even point. After that, it's up to you. You can continue to keep raising your stop, but that's really the start. If you've got an EMA that's now rising. So looking at that, price popped up here above the moving average, so that made it start to rise. And then his suggestion, of course, is you want to wait till it can come back down close to that EMA. Well, the next trading day, we had price get close down to that EMA again. So that would be where you would enter. And you would continue the play. And remember, your first setting of your stop is that last minor low. So it would be right around in here. And then price is going to rise, and then you set your stop to that break-even point up here. So now you've got price rising, dipped below that EMA, but it closed above it. So it didn't start declining at that point. We have the close above the EMA over here. So once you're in and you've got your stop set, you just keep waiting until you get to where it comes back down and hits that EMA again. And now that EMA is in decline, and that brings us to the next trading rule. When the EMA is falling, you trade from the short side. And you start that short once you get that rally near the EMA. So remember, the EMA is falling. You're now below it, okay? And you want to start trading short. So it goes down, and then you want it to actually come up toward that EMA, and then that's when you want to get in. It's not always that easy, but once you're in, and this is for shorting, you set your stop above the latest minor high. And then when you can, you move your stop to that break-even point once prices fall to where you need them to fall. So looking at that, that would bring us back here. I'm going to show you this example. So price, the EMA started to go down actually on this bar right here because it closed there below. So that was your indication that, okay, I want to short, but now I want to try and wait until price is as close to that EMA as possible. Well, honestly, you're right there on it. The next trading bar, we do see it gets back up above it, but then it closes just below it. It's the perfect entry as far as a short is concerned. Get in here, excuse me, you get in here, you set your stop at the last minor high. So that would be way up here. And again, you can make your choices, but that's where he says you'd set it. And then once you get to a point, like right down here, then you can move that stop closer, tighten it up to where you're getting closer to a break-even point. So he would have you in, you would continue to stay in. You'd probably hit here. It wouldn't have been a great trade on a short because you would have closed just below what you wanted for your target, your break-even point. So you'd probably end up just under it. But that gives you the idea of how it works. So back here, we had that EMA turned down right here on that second bar. So he says to wait until it can get back up close to that other EMA. Well, you know, we get the big giant gap down. So to me, that would be, yes, I'd like to try and get in when it gets as high as it does during the day. So I'd be watching that 10-minute bar chart or such. So you would get in right around here. And then again, you would hold on to it. Your break-even point, clearly you're going to get low enough, so you'll have that break-even point stop. For me, I would be watching this, and as soon as prices started to turn like this, I would probably be out as far as a short. But if you're going by a mechanical signal, for Elder, it would be when you got to that break-even point, or you start seeing the EMA turning up. The third general trading rule is if you have a flat EMA, that means you've got a directionless market or stock. So you don't want to use a trend following method if there's no trend. So just that trading rule is pretty easy. Just don't get in one way or the other when your EMA is flat. A couple more pieces of information you should know about moving averages, that they can be used for support and resistance areas. And you see us do that quite a bit. Tom uses the 20-day EMA as a support resistance level all the time, as well as the 50-day simple moving average. Moving averages, we also use them with indicators. So for example, with my price momentum oscillator, I use the signal line as simply a moving average of the PMO values over time. So that becomes my signal line. If the PMO crosses below it, I get a sell. And if it crosses above the signal line, I get a buy. You can also construct bands, channels, or envelopes around your moving averages. For example, a Bollinger Band is a band around a moving average. So you can use those if you want in addition to, and look for those penetrations above or below those Bollinger Bands as well for your trading. And then what's really important that I want you to understand is moving averages are telling us a trend of some amount of data. And in general, obviously, you're looking at moving averages of price. I need to know not only price trend, but I need to have some confirmation and some information on the condition of what's going on with that stock or market. That's where I use my on balance volume. That's where I use my PMO. So trend and EMAs, that's just one piece of the puzzle. And I did have somebody ask me a question, how would you combine that? And I'll give you an example when we are finishing here and I get into the trend models. So the other thing we have are the dual moving averages, where you compare a short-term consensus of value to a longer-term consensus of value. That's basically what you're doing when you're looking at dual moving averages. And that's when the best way to use two moving averages, I feel, is to look for those crossovers. And that's exactly what I end up doing with my decision point trend models. Yes, and Dr. Elder does say that the space in between is the consensus of, it's the value zone, because that you've got short term and longer term. If you're right in between those, you're in a good value. It's when you get overbought and you start seeing penetrations on one side or the other of those moving averages. So the decision point trend models are really a dual moving average study for you to look at. Our short-term trend model is simply 5 and 20-day EMA crossovers, and that is in relation to the 50-day EMA. And I say that because if I get the crossover above the 50-day EMA, a negative crossover, I make it a neutral. But if I get a negative crossover of the 5 and 20 below the 50, there's already some big problems there, because I'm now, I have an EMA, a shorter term EMA below a longer term one. And so that's why I would go to a sell signal at that point. The intermediate term trend model, same deal, 20, 50-day EMA crossovers, but that's in relation to the 200-day EMA. So if I get a negative crossover and I am above the 200-day EMA, that means I'm still in a bull market configuration if the 50 is above the 200. So if I get a negative crossover, I don't really want to go all the way and do a sell signal. I want to go neutral. And for us, neutral means that you're fully hedged or in cash. Long-term trend model is a lot easier because all you do is look at 50 and 200-day EMA crossovers. Positive crossover, long-term trend model buy. Negative crossover, long-term trend model sell. So here's a quick example of how these work. These are the long-term and intermediate-term trend model signals. So there's your 50, 200-day crossover, positive crossovers. So that would be a long-term trend model buy. We can see here the difference between your neutrals and your sells. So the intermediate term trend model is based on 20 and 50-day crossovers. So I got a negative crossover, but it was above the 200-day EMA. So that puts me in neutral, not a sell. However, if this crossover had occurred just under the 200-day EMA, I'm in a bear market configuration. So if I get a negative crossover on my 2050, I want to go to a sell, not a neutral. And so that gives you positive crossovers are always buy signals. So that's easy. The short-term trend model, again, those are 5 and 20-day EMA crossovers. The negative crossover happens above the 50, it's neutral. If it happens below, it is considered a sell signal. You can see one right back in here. And of course, positive crossovers are always buys. So that's how the decision point uses the exponential moving averages. So really what I want to give you as workshop takeaways that you should remember is, first of all, with simple moving averages, yes, they are easy to calculate and understand, but they are susceptible to a drop-off effect, especially the shorter amount of the time period you're looking at. And exponential moving averages are weighted. And so that gives them a greater emphasis on the near term data points. So if you're more interested in what's been happening with the trend on the near term, that's where you want to go. Dual moving averages, that's great to use for your crossovers and all of that. I really like these to use dual moving averages. I think that's where you get the most information. And with that, I'm going to conclude my workshop on moving averages. And if there were any questions in the chat box for the Market Watchers live show, I am ready to answer them.
All right. Well, I don't have that chat box up. So I think maybe what you should do, Erin, if you don't mind, is when I go into the correlations later, maybe you can answer those directly in the chat room, or maybe send responses out.
Absolutely.
That would be great.
Yeah. Wow. There's a few in here. Excellent. Yeah, I'll go through those. I'll make a note of those, and then yeah, I'll answer a few of them at the end.
Yeah, we want to pull up that poll again and see.
Yes, let's look at the poll. I don't know if maybe people changed their minds. Maybe they're going to start using different moving averages based on what we saw. So let's take a peek at that for sure. And let's see what I'm seeing currently as far as the poll. Well, we ended up moving a little bit differently here. I don't see it up on the screen, but I can tell you what we're looking at in the room. Remember, the mix of both on the same chart were leading. It's still leading, but it's only at 39%. And using EMAs went to 37, and simple. Oh, here we go. Yes, look at it. It's just moving all around as you guys begin to change your votes or add your votes. So I think this seems pretty much on par. I would have expected to see more people using EMAs. This was the surprise, and I think it was a surprise to you, Tom, as well, that we can see a mix of both on the same chart, that the majority are using a mix. So
I'm shocked.
I know. Just if you are using two on the same chart, you need to think about it like Tom does. When he's looking at a shorter term, number one, you don't have to worry about drop off with a shorter term if you're using an EMA, and it puts more emphasis on that near term data. And I know that's what you like to look at as far as where the price is in relation to the more recent price trend, and that is, you see that a bit more on an EMA. But I know you use your longer term or simple moving averages because you want to get the big picture. Am I right?
Yeah, I mean, for me, it makes more sense in the short term. I mean, if you're looking at a short term moving average, there's a reason why you're focusing on the more recent data. So a lot of times in my trading, I use the 20-day EMA a lot. But I want to have that focus skewed toward the most recent data within those 20 days. So I'm fine with an EMA on that. What I can't, for me, I just can't get my arms around looking at say a 200-day moving average, which goes back literally almost a year. I mean, there's 253 trading days. So if you're going back 200 days, you're essentially looking at, 80% of the year, and then you're going to skew the data toward the most. I don't understand the concept with a long-term moving average to skew.
Yeah, for me, I still think about drop off. So, for example, if we go into this big rally and now we're looking back at this correction from, where we had these giant drops, as soon as those drop off the end, the simple moving average is going to hiccup. So for me, I still, and again, my trend models are based on EMAs. So I think they're both excellent. I just think you have to know what you're looking at when you're looking at them.
Yeah, and I think the drop off too. And if you're looking at a 20-day moving average, you only have 20 data points. But if you got 200,
exactly,
for one day dropping off is going to have much of an impact. But again, everybody has their own way of looking at it. There's not a right or wrong way. It's just
absolutely
what you
well,
prefer, what you're comfortable with.
right. And I know people talk a lot about the the death cross, but they're usually talking about a 50 and a 200 simple moving average negative crossover on a chart. That's considered a quote unquote death cross. But you're not going to see that happen on an EMA quite at the same time because the way they're calculated. All right, I am getting in those last minute symbols right now for the 10 and 10. And I will steal the screen shortly once I get a few of these in. And let's see. Forgive me if I didn't get yours in here, but we need to move on. So I'm going to just throw a few more on here. Okay. And I will get that screen for us. All right. So here are 35 of them. And I apologize if yours didn't make it, but I had to do this on the fly. So let's see. I'm going to take a peek at these in that RRG. And let's see what we're looking at as far as rotation. And that's what we want to. So we've got some outliers here that might be interesting to look at. The majority of the ones everybody wants to see, though, are in the leading categories. A couple of those are starting to move in to that category of the improving. So it'll be interesting. I'll pull a few of these and put your likes in on the symbols you want to see. And the most popular one will be our second 10 and 10 symbol. But our first is Goose, Goos.
All right. Well, I did annotate this one. So you can see for me, the huge gap down on very heavy volume, I think established a major support level down here at about 30 and a half. Of course, prior to the gap down, our high was up at 38. So I think we're in a trading range. We've been trending higher. I would be much more bullish the stock if we could see volume come in and we could break back through the top of gap resistance and, of course, the price resistance that was established at $38. So I'm kind of in a holding pattern on this one at this point. I do like the overall pattern. I like the move higher and then the rising lows. If we fail to hold this trend and break below that 50-day moving average, though, I think it does open up possibly another move down to 30 and a half. So I'd just be watching it closely.
All righty, let's see what is our most popular in the room right now as far as our symbol request. Intel, INTC.
All right, well, first let me say they report after the bell tonight. So as far as any technical outlook and that sort of thing, I think it really is difficult when you're heading into earnings. Things can change in a hurry, as we've seen with many companies. But clearly, I would really like to see Intel come out with a good report and open up tomorrow above $54. That would be the first step, in my opinion, to seeing additional strengthening for the stock. I mentioned earlier today, I like Intel's chart much better than AMD, Advanced Micro. And you can see here, we've got beautiful rising lows. If you look at that AMD chart, it's been, until today, it's been declining. So I think you've got a much better, the market is certainly anticipating much better numbers out of Intel than AMD. And so let's see what kind of reaction we get and go from there. I don't like to hold into earnings, so I would avoid the stock heading into earnings. But I do expect, based on the way it's trading, that they're going to come out with a pretty nice report. And if we get that reaction above 54, that would be bullish.
All righty. So the next one we're going to look at is cake. I want to have my cake and eat it too. Cheesecake Factory.
All right. Someone out there knew I didn't eat lunch or breakfast. I have to throw that in there. I don't like today's candle. Now we'll see how it finishes, but I don't like when if I was in the stock and I saw this breakout and then coming back down below 53, I don't know. I may have gotten stopped out. Maybe because it's early in the day, I'd hold and just see how we finish. But if we finish with a candle that looks similar to this, I would expect to see additional weakness in the near term. Now, the next level to the downside, probably not a whole lot of downside here that I would look for. The recent low kind of coincides with the breakout here. And then we also had a level in at about 50 and a half to 50.75. So I don't know. I think if we fail, I would look for maybe this 50 area to hold on a pullback. If I was sitting down waiting to get in, I would definitely continue waiting. I don't like this false breakout. And again, if it continues into the close, I think maybe you might be able to get it 3-4% cheaper down closer to that 50 level.
All right. I think this one gets asked for every single day. So I'm going to do it. We haven't done it in a while. Snap.
Yeah, Snap is, whoa, it's come back down quite a bit. It was up near 15 when I was looking earlier today. Snap, I know Twitter got an upgrade today, and of course, Facebook had great news. So, internet stocks were having a really strong day and were one of the best performing industry groups. So, that was helping Snap move back up higher. I think that this one's in a fairly tight range now for this stock because it is kind of volatile. But the gap down here and the reversing candle, I think, established what I would consider to be a pretty significant low because we did have gap support at 14. We opened below that level, probably scared a lot of folks, although volume wasn't huge. But it did reverse back off of that. So I think 1370 or so is a really key area of support. And now we have gap resistance and that false move from Tuesday, trying to get through $16. I think this is the trading range right now for Snap. So we're sitting in the middle of it. I think, it could go either way here. We probably still got another couple weeks before we get into earnings, which looks like probably be the second week of May. I would expect to see a pre-earnings run up in Snap. I've been calling for that for a while. It doesn't seem to be listening to me, and it's continuing to trade in the middle of this range. So I wouldn't do anything if I wasn't in Snap at this point. I like it better as it moves below 14, and I definitely like it more on the sell side as it gets closer to 16.
All right. We are going to look at Bitcoin GBTC. I looked at the chart myself, and you could see earlier in the year the parabolic that busted, but now it seems to be trading just above its previous basing pattern.
Yeah, I mean, there are a lot of folks saying it was a fad and it's not real. Others are still saying it's real. It just needed to settle down because it's gone up so much. I would just say this. I think that if it is beginning, you can see for the first time in the last few months, we have broken back out above the center line resistance. So I do think that this is a somewhat bullish short-term development right here. We did make a breakout above highs. We're starting to put in lower highs, or excuse me, higher lows and higher highs. And so on a pullback, I would like to see Bitcoin hold on to that rising 20-day. We went just below it back a little, well, maybe a couple weeks ago, made another breakout, came back down, just about tested the 20-day yesterday, trying to rise off of it. I'd like to see that 20 hold and see the 20 move back through the 50 and get that golden cross that you were referring to earlier. I think that would start to add some confirmation to the chart.
Absolutely. All right, the next one we're going to do is Nu Skin Enterprises, NUS. That's in the staples.
All right, let's take a look. I'm going to pull this one up in the relative chart and see what's going on here. A beautiful uptrend looking back last several months, yet its overall group has been moving lower on an absolute basis. So clearly you've got outperformance. You've got outperformance above the S&P, although it did pull back briefly just a couple of weeks ago. And the group has been very weak. So Nu Skin being able to rise against the S&P 500 while its peers are moving lower tells me that you've got a good stock, but you just don't have a good space. So if we could start to see some strength resume in its peers, and we can get back through that 20-day moving average, I would start to like the stock a lot better. So I think what I would be keeping an eye on here is simply whether or not we can make this breakout back above the moving averages. Because keep in mind, when you lose that 20-day moving average with a big candle like that, and you keep coming up here and failing, and now you're getting a death cross beneath, you need to get back through. We saw this a little bit back in early November where we went below, came right back up through, and then you can see we continue to strengthen. That's what we're trying to get here. We're right up against it, so I think this is the wrong time to be thinking about entering. I would want to see that breakout first. So see the stock trading up around 72.75 to 73, and the volume starts picking up. I would like it a lot more.
All right. Let's see. For our Canadian friends, Yangara Resources, YGR.TO.
All right, that's not going to help us on the relative chart. So let's just pull up a daily chart. Yeah, beautiful breakout. Our Canadian friends that have been giving us some charts lately have been giving us some really good ones. This one's just a little overbought, similar to, I think it was an energy play yesterday, maybe that I looked at. But here you can see a big breakout. Look at the volume coming in. This is what I like to see. I like to see the commitment of buyers moving in. If this was, if we were seeing this kind of volume that we saw in March on this move to the upside, I would be taking the breakout maybe with a grain of salt. But this looks like there's some accumulation taking place. Look at today's volume, by the way, already over 500,000 shares. We're just a little bit past the halfway point of the day. Looks like it's going to be another really strong day. I just want to try and get it where I can manage my risk. If you get in here and you're using the rising 20-day as a stop, you got to give it 10% to the downside. I don't like to do that with trades. So I'm going to wait. I'm going to have it on a watch list. And if the stock pulls back, maybe even set up a predefined alert. You can do that at stock charts. We've shown you how to do that before. But maybe set up a predefined alert for when the stock goes back down and hits its 20-day moving average, or maybe it goes back down and hits the breakout area around 560, 570, something like that, so that stock charts does the work for you. But I like the chart. I just think it's overbought in the near term.
All right. Let's see, biotech, Alexion Pharmaceuticals, ALXN.
Yeah, I think they just reported, I believe. Yeah, huge move up. I really like the candle. This is an incredibly volatile stock, though. I've actually owned this one a couple times. I don't think I did very well with it from what I recall. But it is a volatile stock. Look at the gap up that we saw back in March. Stock was 122.5, went to 137.5. And literally by the end of the month, it was back to 107.5. I mean, that's the kind of volatility that you have to be prepared for. So I think if I were playing it, I would have to be looking at a key area of support to keep a stop. And for me, it's going to be the bottom of today's candle body. So that gap up right there, that open, to me is going to be really important going forward. We have a lot of volume. Obviously, we gapped up, we pulled back, and then essentially broke back out through today's open. So that is where I would look for support on any pullback. Whether or not you chase it here, if I was going to buy any at this level, I'd at least save some powder if I were to move back, say, to 114 or so. And then I could keep maybe a closing stop around 112.5.
All right. And our final one, Eastman Chemical, EMN, commodity chemicals is what they are in as far as industry.
I'm only showing 8 done so far, so I'm not sure.
Oh, did I miss a few?
What was that? Was it EME or EMN?
EMN.
EMN. Okay. I think this may have been earnings too. I thought I saw them on the list, but the reaction isn't very good. So, or it's just not much volume. So maybe I'm off on that. But we do have an uptrend in play. We had a reversing candle on the top. So one of the reasons, when I did my workshop not that long ago on reasons to sell, one of them was reversing candlestick. So you get that move to the upside, and then all of a sudden you get a bearish engulfing candle like that. That's normally a sign that maybe the stock's run too much in the short term. So as a short-term trader, you might be interested in getting out and buying back in cheaper. From a longer-term perspective, though, if you're just looking at, is the stock performing well and is it continuing to move higher? I think we could take a look at this and say, well, I think we're still in a very nice uptrend, continuing to print higher highs and higher lows. So I'd be okay with it. So that's just looking at the stock two different ways. But I do like it here. I would say maybe gap support around 102 and change is a level I would watch. That was where we were before we gapped up. Look at these tails coming down here, testing the 50-day moving average, getting close to gap support. So I'm going to say 102 to 104 is an area of accumulation. Stop maybe below 102 if you want to give it a little bit more room, maybe 100. But I would be looking for a return back up to the 110, 112 area.
All right. And I did miss one. I'd written it down and I didn't tell you. Insys Therapeutics, INSY. This one has a pretty nice look on the RRG.
Yeah, I would just say, again, this is going to be an extremely volatile stock. From 1st of December to the 1st of January, the stock tripled. So that ought to give you an idea of how quickly it can move. But you have to keep in mind it can move in both directions. It went from 13.5 down to about 8 in 2 or 3 weeks. So when it starts moving, it can move fast, but also, you can lose it very quickly, just as easily as you can gain it. So just want to throw that caution out there. I don't know this company, so I have a feeling it's a pretty small company. I like the chart. I think it's starting to strengthen. You can see the PPO breaking back up above the center line. You also can see that nice bullish test of the rising 20-day moving average, and it is trying to make another breakout. This is a stock that doesn't trade a lot of volume, though, at times. Now it's starting to pick back up again, so I don't think liquidity is a problem at this point. My target, I think you got maybe $8 to the upside in the near term. And I'm looking at this gap down on increasing volume. We haven't gone all the way back up to fill the gap. So I think if you get to 8, especially if you print an intraday move above 8, you fail to close above, that's when I would be careful and take my profits. But it is starting to strengthen, no doubt about it.
All right. And that was 10 in 10. You actually did pretty good. We went through those very fast. And here are the symbols. They will be, if you go to the blogs tab and click on the Market Watchers Live blog, you will find the Market Watchers Live chart list. And these will be in there with those annotations after the show. So you can go in there and steal some of those if you want for your own chart lists. And with that, let's move on. I would like to share with you ChartCon 2018 coming up. I know everybody's like, when is August going to get here? So they're so excited for this. I know I am. Reducing risk.
I was just going to say I am as well. And, later this week, we got 2 of the speakers coming into the show, Tom McClellan and Bruce Fraser. And you go down that list. And again, I think the key here is managing risk. I love the theme of ChartCon this year, because I do think that most traders I know, at least folks I've been around, have no problems buying, but they have a problem selling. And a lot of that is being able to manage your risk appropriately, and that's really what the whole conference is about. So what a list of speakers, though.
I know. And for those of you who were here for my moving average workshop, Dr. Elder will be one of the speakers at the 2018 ChartCon. And again, everybody, it is online, so you don't have to come to Seattle to do this. It's simply an online conference. And if you go to register, you want to do that as soon as possible, because this is an early bird price. And that is going to be going away, I think, the first week of May. And it will go back to its cost of $2.99. So want to go and do that now. You'll get to see everybody's, it's all going to be recorded for you, but you can sit in live like you are right now for Market Watchers if you're watching with us live. And you also will get all of those recordings for yourself to have on your hard drive or have access to, so that you can go back and look at whatever programs or speakers that you really enjoyed and want to see again. So
yeah, I'd also add, I think last time either Grayson was on the show or maybe I was talking to him outside the show, but I think he said the event price is going to be $249.
Ah, okay.
$299, but either way, whether you save $50 or $100, why wouldn't you want to save it?
Exactly. Here you go.
Yeah, that says $299, but I'm not sure.
Oh, well,
It's going to be 20% off.
Yeah. Maybe that'll be the next price jump after May 5th.
Yeah, I'm not sure.
Still will be able to get a bonus, but not $100. It'll only be about $50. So definitely recommend. Again, it's streaming online. We'll have opportunities and apps for you to use to keep the conversation going with us while we're at ChartCon. I know you and I and Greg had the most fun with that. They had a social networking kind of app that we were using, and it was specifically for ChartCon. And so I know the 3 of us had some great time posting pictures and making random comments about the different speakers. It was a lot of fun.
Yep. We look forward to it, no doubt about it. And it's going to come up a lot faster than you think. I mean, I can't believe it's already almost the end of April. It seems like we just had New Year's.
I know. I was just telling my husband John that I can't figure out where April went. It's almost out. All right. Well, let's go ahead and let's get into our final market update. And I will get that ready for you. All right, I'm going to just go over the candle glance here, and then we'll move right on. I have changed it. I've added the TSX for our Canadian friends, and then I decided to add the XLE just to see what's going on with energy. Why not? All right. As you can see, the markets are up today, which is a nice change to see us getting into the moving higher. And of course, we are starting to hit these intraday highs on all of these major markets. The Russell 2000 not quite reaching its prior intraday high, but it looks like it might be headed back that way, especially when you start seeing these major markets, including the TSX, on their way up. You can see Treasury yields gap down, moving sideways, currently reading at 2.998. UUP started the day lower, gap down, but made a huge surge in the morning. It is starting to come off those intraday highs, but we're still looking at UUP at 2401. I finally got that dollar breakout. It finally happened. Been waiting for so long. Now we can see commodities are up slightly, formed a sort of a double bottom W shape here. And we can see that USO is up slightly, and gold down quite a bit, likely because of the surge in the dollar. But currently GLD is reading at 124.86. The VIX is at 16.78 and moving lower. We're seeing investors get a lot less nervous as they see these markets moving higher today. And energy continuing a nice run from yesterday, moving higher and reading currently XLE at 74.22. And with that, I'm going to pass it back to you, Tom, for correlation, or if you wanted to add a chart to what we looked at for the market update. And I'm going to go into the chat room and find questions regarding moving averages.
All right, sounds good. Yeah, I don't really have anything to add to what's going on. I mean, I would say, we like to see trend days. As if you're bullish, you like to see these trend days when you open up and you just keep trading higher throughout the day, because it does reek of accumulation. So that would be one thing that I would be looking for over the balance of the day, but really nothing else to add to what's going on today. Let's take a look though at correlation, because correlation is it's a really cool indicator that I don't know that too many folks here at Stock Charts uses it, but I'm going to give you just a quick tutorial in it, maybe some specific uses for it. I've done correlation before, and this is one of the charts I think I showed last time, where you take a look at Starbucks and you think, okay, what does Starbucks correlate well to or inversely correlate to? And I think one thing that might jump out at you is coffee prices. I mean, that's pretty normal thing. I mean, if you're looking at the correlation or you're looking at the direction of Starbucks coffee, you would think that they're going to benefit by lower coffee prices, because I know when prices are going lower in coffee, I don't see my lattes getting any cheaper at Starbucks. So I would think that lower coffee prices are probably going to help Starbucks bottom line, whereas higher coffee prices might provide some headwinds for the stock. And so anyway, on this chart, what I did is I showed the price of Starbucks here, and then the pink you can see is actually the price of coffee, and you can put this behind the price. So what I've done down here at the bottom is I've put in coffee. One of the indicators is price. I put in coffee, and then you have these choices where you want to put it. Do you want to have it in a separate window below, a window above? You can put it behind price, or you can put it behind another indicator. I chose to put it behind price. So that's why you're seeing the pink show up here, pink lines behind coffee. So I could look at this chart and maybe start to make some, maybe start to conclude some things about the price of coffee and Starbucks. I mean, it looks to me like Starbucks does pretty well when the price of coffee is going down. And then when the price of coffee shoots up, it looks like Starbucks stock comes down there. We have a move up there and Starbucks comes down. And then here we have a big move up in coffee, and Starbucks kind of goes sideways to down a little bit. So I would look at this, and without even pulling up correlation, I would say that there's probably an inverse correlation present. Well, when you look at the chart, you'll see that for the most part is true. This is correlation. And actually, I don't know why I have this one smaller. I'm going to increase the height here. And actually, I'm also going to put it above RSI. I don't really need RSI in here at all, to be honest. All right, so let's take another look. Now, I didn't highlight it, but I think you can see that, especially since 2011, we've spent most of our time having inverse correlation, meaning that when coffee prices are going in one direction, Starbucks tends to move in the other direction. Now, if that was the case every single day, then we would see a straight line down here at -1. That means that it's completely inversely correlated. And if they move together to the upside, we'd have +1. Well, I think we can maybe just make a rational conclusion here that the price of Starbucks stock and the price of coffee tend to move opposite one another, but not always, but usually. And so one of the things that I find very interesting, Starbucks reports after the close today, and you can see that over the last 15, 18 months, coffee prices have been going down. Starbucks stock has been flat, maybe a little bit of upside movement, but here in the first quarter, coffee prices did tumble. And I wouldn't be shocked to see Starbucks come out with a really big report tonight. I don't know if it's enough that I would be willing to take a chance and holding it into earnings, but I don't know. Maybe I would. Maybe I would hold Starbucks into earnings. This one's almost guaranteed to go down now based on that comment. But Starbucks, I do think has been consolidating for a while. Obviously, technically, it would be huge to get a breakout on Starbucks, and we'd have to see about a $5 or $6 jump to take out the high that we saw a little less than a year ago. It looks like maybe in May or June of 2017 when we reached that high. But I think the ingredients, no pun intended, I think the ingredients are in play here for Starbucks to make a jump with solid results after the bell. So that's just one look at correlation. Let's take a look at ExxonMobil. What might be something that would correlate well with ExxonMobil? I thought maybe the price of crude oil, maybe. So if you take a look at ExxonMobil, again, I've got the chart here, and the pink line is crude oil prices. And if you just, again, look at the chart, you might think, well, they tend to kind of go together. When crude oil is going up, it seems like Exxon's going up. When crude oil goes down, Exxon goes down. Well, the correlation indicator tells you that is pretty true. Almost all the time over the last 10 years has been spent positive territory, meaning that these two do tend to trend in the same direction. Now, what I find interesting, there have been a couple of periods where we've had some inverse correlation where they move opposite one another and then they play catch up very quickly again, as you can see. And we just did that again in mid 2017. Looked like we were moving into inverse territory, and then all of a sudden we had this big spike and they became tied together once again. Well, now look at where we are. For only about the fifth or sixth time, we've moved into negative territory again between the price of ExxonMobil stock and the direction of crude oil prices. Look what crude oil prices are doing. Big move up. We've talked about this a lot on the show and in my blog, how crude oil prices have made a really big breakout and how we were waiting for the XLE to play catch up. Well, the XLE started to play catch up mainly because XOM is the biggest holding in that XLE ETF, energy ETF. So here's a big move, but you can see we're nowhere even near the top of what we've seen over the past few years. And yet energy is at the highest level we've seen, or crude oil prices, I should say, are at the highest level we've seen in about 3 years. So I think the move up in crude oil could lead to a continuing surge in ExxonMobil shares. That's what I would take away from this chart. Next up, GDX. Now you might think, okay, GDX, that's the gold miners. They might have a correlation with gold, right? So you take a look at the GDX and you set up the correlation with gold. And look at this. This is a very strong correlation. And it makes sense. If gold prices are rising, then chances are the miners are going to be making a lot more money. And their prices should be moving higher as well. Now, is it a perfect correlation? No, but it's a pretty strong one. This is as strong as any that we've shown so far. So what might have an impact on GDX outside of the price of gold? Well, how about the US dollar? The dollar has we've talked about the dollar and gold many times on the show, where when the dollar's rising, gold tends to suffer. And when the dollar's falling, gold has a much better chance to rise. And if the GDX and gold tend to move hand in hand, then it kind of makes sense that GDX and the dollar would have an inverse relationship. And that's what this chart shows us. So we've got GDX up there, but also the price. I've got the US dollar. So that is the pink right here, the dollar. And if you notice, for the most part, when we've got the dollar going down, you got GDX going up. When the dollar is going up, GDX is going down. and so forth. Now, I find a couple things interesting about this chart. Number one, if you connect the major peaks over the last, well, really during the bull market in the stock market since 2009, if you connect these peaks in GDX, which have been downtrending, you can see that comes in right now probably at about 24. And if you look at the last year and a half, the highs on the GDX have been topping out at about 25. So that's a pretty significant resistance area on GDX. And I circled this move here in the dollar because Erin and I have talked about this quite a bit on the show. She's been bullish the dollar. I've been bullish the dollar for different reasons, but we're still coming up bullish the dollar. And if the dollar is starting to turn higher, which it appears it is, I think that's going to be really bad news for gold and the miners. I have not liked the miners or gold. I know we've had some short-term pops every now and again. I think the big picture still lines up for a rising dollar and therefore weakening GDX and weakening gold. There's your inverse correlation down at the bottom there. Banks. What could correlate with the banks? How about treasury yields? I think that would probably be a pretty good one. Here is a chart of the banks. And then here are your treasury yields in the pink line. Now, over the course of the last, I don't know, maybe 20 months or so, we have seen a huge move up in treasury yields. Well, we've also seen a pretty nice move up in the bank stocks. Looking at the correlation, yeah, there's pretty tight positive correlation between the direction of banks and the direction of treasury yields. We've talked about that a lot on the show. I can certainly vouch for it based on my fundamental time as a CPA auditing banks. I know that when treasury yields are rising, when interest rates in general are rising, banks start to get more aggressive. When they don't have loan losses, they do come out of their conservative shell and they'll start reallocating the assets on their balance sheet. Less Federal Home Loan Bank securities, less treasury securities, and more loans. And as a result, that's what keeps the economy going. We're a credit-driven economy. So I always like to see banks doing well because to me, that is a good sign for the market. And the banks recently, this is a little bit of a short-term concern. Treasury yields have been going up. Banks actually have been going down. And look at the positive correlation that we had to start the year and look at what's going on. Now, this isn't completely unusual. You can look back and see there have been periods where we've had negative correlation, but I believe treasury yields are going to continue to rise. And looking at this chart telling me that banks tend to move with the treasury yields, I would have to say, based on everything I'm seeing on this chart, the fact that banks have pulled back, it's a buying opportunity. So another way to use correlation with the banks and treasury yields. And then the final chart I have for you is the XLY:XLP, consumer discretionary versus consumer staples. That's what this chart is here, showing the direction. And then also look at the direction. The pink line is the S&P 500. So here you've got the consumer discretionary, for the most part, continuing to outperform consumer staples. That's why this ratio keeps going up. And it coincides with the S&P 500. And when we look at correlation, you can type in the correlation. I'm going to go down and show you this one. You've got the S&P 500 here, and up here I've got XLY:XLP. So the way it'll show up is XLY:XLP, dollar SPX. And that correlation has been positive. Now this is positive through, during this bull market, but it also correlates during bear markets as well. This is the one go-to that I use underneath the surface of the market to try to determine whether or not an S&P 500 rally is sustainable. When I see the XLY outperforming the XLP, I am very bullish the S&P 500 because as this ratio goes up, the correlation tells me. If you didn't believe me, you could just put the correlation in and you can see that the two tend to be very positively correlated. So, if you're going to try, if you're just thinking about something in the market and you want to take a look to see what could that possibly correlate to, or if you have an idea that it might correlate to something, put it in here. Use the correlation indicator, and it'll come up. Your default will be dollar $SPX, 20. That's the parameter. And if you want to compare it to something else, let's say I want to compare this to the direction of crude oil prices, I just simply switch that and update it. And now all of a sudden, you're going to see that it tends to correlate pretty well with direction of crude oil prices too, because the economy global economic conditions generally are strong when crude oil prices are going up. And that's also the case for the XLY XLP. So this to me is not a shock that we see positive correlation here. So anyway, that's basically what I have for the correlation. So let's pull up a summary slide for you, and you can take a look and see that, or at least the 5 or 6 items that I did bring up and go over in correlation.
Excellent.
Yeah.
I did end up having a couple of questions to answer. I'll just, if I can do that real quick. There's our correlation. Let's see those symbols. There we go.
Yeah, and I will say that the parenthesis in there around the XLY colon XLP, you don't have to type those parentheses in. I just didn't want that to show on that slide, colon and another colon, without kind of identifying what we were doing there. So anyway.
Excellent.
Go ahead. Go. What questions do you have?
All right. Isn't this beautiful? Somebody asked, some people use 6, 7, 8 or more EMAs or moving averages on their charts. I have to agree with the person. I think it's a little bit too much data, but at the same time, you can see the waves as to what's going on. The other question was using a 800-day moving average as a valuation line. And I think you could certainly do that. I think I've heard people using that. The other one was, does it make sense that a 200-day moving average on a daily chart is closely equivalent to a 40-week moving average on a weekly chart? And that is true. In fact, for the 50-day, 200-day EMAs that I use on a daily chart, I've translated them to a 17-week and 43-week EMA for my weekly chart. And I get the crossovers at about the same time as I do with a 50 and a 200-day crossover. And let's see, is it better to use the moving averages that most traders use or experiment? And I would say, yes, experiment. Dr. Elder does say not to use anything less than an 8-day EMA, but my short-term trading window is about 2 weeks, and half of 10 trading days is 5 days. So that's why I use that as my very short term. Intermediate term, you're looking at usually a 20-day EMA. Longer term, you're looking at those 50, 200-day EMAs for sure. And I think that was the majority. And yes, moving averages are dynamic or real-time trend lines. I definitely would agree with that. And I think we discussed why we use mixed EMAs and SMAs. So if you go back through the presentation, you should find that. And yep, one quick thing, minor low. What is a minor low? It's usually it's not the main support resistance. It's the previous, like the last time you saw a bottom and the last time you saw a top. That's what you would consider your minor lows. And as far as our weekly schedule, everything's stock charts. We've got seasonality coming up. Tom McClellan and Bruce Frazier. I'll be going over monthly charts on May 1st. You'll want to be a part of it for sure. And with that, I'm going to say adieu and pass it back to you, Tom.
Sounds good. Yeah, another great show. Let's see how the market finishes today. I mean, that's going to be the key, I think, as we go into the afternoon. Can we sustain this move to the upside as opposed to a reversal? So far, we're doing a great job. Dow up 260 and NASDAQ up 118. I want to thank everybody for being with us today. Please remember to complete that survey as you exit. I'm sure Erin would love to know what you thought of her workshop today. And we do always like to get your feedback regarding Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. Hopefully, we'll see you back here on Friday. Happy trading.